what's going on YouTube? My name is Jason J. Hamilton, and I am a chartered retirement planning counselor. And welcome to my page. I'm going to be trying something new here. Typically, I post at least a video a week, but I'm going to try to do these live a little bit more often instead of just reposting from the training on my Facebook page. I want to see, what the audience is like on YouTube. You may have different concerns, different questions. So I want to be here to help you retire with confidence and answer your questions. So today we're going to talk a little bit about something that has been in the news recently. If you haven't heard, there's been some proposed changes in legislation regarding the way capital gains are taxed. If you're not familiar with what capital gains are, we'll definitely talk about that a little bit. But what I do want to let you know is that YouTube is wonderful, but if you want to join us on Facebook, there's a lot more discussion there. There's two places you can go. You can either search for the group that I'm the admin of called Your Retirement Coach, or go to my page at Retire Simple. And that's a real easy one to find and connect with me there. So YouTube is great as well. I would love to have your comments down below, have any questions down below, anything that comes up. But YouTube, it seems like it's not getting quite the reach as we do on Facebook, but I'm going to see what we can do here to make this something very special and cater to the audience here on YouTube. So if you have any questions at all, please leave them down below in the comments and I will respond to you. I will answer them, and I would love your feedback on anything that we talk about today. So as I mentioned, we're going to do a little bit of a training today on really some legislation that hasn't happened yet, but it may happen. And if you're planning for retirement, this could be really, really important for you when it comes to your retirement income planning. So let's see if we're up and running here. Let's try this out. All right. Let me add me down in the bottom corner. So before we get into this, let me talk a little bit about what capital gains even are. So if you are investing really in anything, let's use a house for example. Let's say you buy a house for $250,000, right? And that's what's called your basis, right? Because that's what you put into the house. So if you bought the house for $250,000 and you sold it for $250,000, you have no gains at all. If you were to buy the house for $250,000 and sell it for $500,000, you would have $250,000 in gain. The great thing with home purchase is that there's a huge exclusion of up to $250,000 that you can have in gain. And as long as you lived in the house for 2 years out of the last 5, you can actually keep that gain completely tax-free if you're single. If you're married, that gain is actually up to $500,000 in gain. So most people don't have to worry too much about paying any sort of capital gains taxes on their home purchases. But let's say you own some stocks or you own some mutual funds or index funds or whatever it may be, and they are not inside of your 401k or your IRA because maybe you need to contribute more than that, or maybe you don't have a plan at work, but you still need to be an investor. So you decide to invest in what's called a taxable account, right? So in taxable accounts, which are not tax preferred accounts, so no IRAs, no 401ks, when you have a gain, you are going to pay either what's called short-term capital gains or long-term capital gains. If you purchase an investment and you make a profit and it goes up in value and you sell it within less than 12 months from when you've owned it, you're going to pay what's called short-term capital gains, and that's going to be taxed at your current tax rate. If you if you've held the investment for over a year, then you're going to pay what are called long-term capital gains. So that's a much more favorable rate for most people, and I'm going to go over exactly what those are. But the idea is that if you're going to be investing, you want to hold most of your investments for at least a year so that you can then qualify for long-term capital gains. That can be very beneficial for you. So we're going to talk about that today. And the change they're potentially proposing to make is to index your capital gains to inflation. So essentially, you're going to get a better deal if you're an investor on how much taxes you have to be owed. So that's what we're going to talk about today. I'm going to show you what that could mean for you if you are investing outside of your retirement accounts. So let's talk about that a little bit here. Okay, so what does it mean to have your capital gains indexed to inflation? There's been a change suggested that would index the cost basis of investments to inflation when calculating capital gains. So I think the best way for me to show you this is through an example. So let's say you bought an investment for $10,000 2 years ago, and now the investment is worth $12,000. Well, currently you would have to pay capital gains taxes on your $2,000 gain because your basis is $10,000, your gain was $2,000. You're only going to have to pay taxes on that $2,000 gain. So for most people, they're probably going to be somewhere in this 15% tax bracket. But what you want to do is figure out, okay, are you a single taxpayer, married, filing jointly, had a household, or merely filing separately? And then you're going to go here to the long-term capital gains rate column, and you're going to figure out, okay, am I in the 0%, am I in the 15%, or am I in the 20%? The majority of people are going to be in this 15%, tax bracket for the most part. If you're in the top 1% of income, you might be in the 20%, but most people are going to be in here. So we'll use an example based on the 15% tax bracket, and I'll show you what that would look like. So going back to the previous example, if you bought an investment for $10,000 and you had a $2,000 gain and your long-term capital gains rate is 15%, then you would owe $2,000 times 15%, which would equal $300 in taxes. So your nets that you would take as your profit would be $1,700, okay? At the current way the capital gains are being taxed. If your capital gains were indexed to inflation, so let's say CPI, or the Consumer Price Index, was 5% over the last 2 years, then you would actually be able to attribute 5% of the gain to inflation. Essentially what that would do is actually increase your basis, and you would pay your 15% tax on the difference. So what does that look like? So in this case, if you your basis would increase from $10,000 to $10,500. So what that looks like is, essentially looks like your original investment was $10,500. So if you sold the investment for $12,000, you would only owe taxes on $1,500 versus the $2,000 like before. So $1,500 times 15% is only $225 in taxes versus the $300. So that's a pretty big savings when it comes to what you would owe in taxes. This is a pretty small gain. So imagine what would happen if you started with a $10,000 investment and it doubled, for example. It'd be a big difference in the amount you would save on taxes if this were to be implemented, okay? So essentially, you would owe $225 in taxes instead. So you get to keep the extra $75 for you and your spending needs. So this could be, a really significant increase in benefit for taxable accounts. Especially, I seem to be, attracting a lot of people to my practice that want to retire early. So what that means is they want to retire at maybe 61 or 62 or even 59 instead of the traditional 65, 67, or even later. So, if you're going to be retiring early, a big thing people forget about is healthcare. You cannot qualify for Medicare until you're at least 65 years old. And if you retire at 61, that could be 4 years of paying for healthcare. And if you were to buy healthcare on the open exchange, pretty easily your monthly healthcare expense could be somewhere between $800 a month and $2,000 a month. And that could definitely be going up over these years as well. So this could be a big unexpected expense that a lot of people don't plan for. Well, if all of your money was in tax-deferred accounts like 401ks or IRAs, for example, then anytime you took money out that you would need to survive on, that would actually be increasing your adjusted gross income. Well, there's actually a special little clause that if you keep your income below a certain level, and I believe it's about 400% of the poverty level, so currently right now, if you keep it below about $48,000 or $49,000, you can possibly qualify for a healthcare subsidy through the ACA or the Obamacare exchange. So if you keep your adjusted gross income lower than that, then you might actually get a huge subsidy and be able to save a lot of money on healthcare. So the way to really do that is to have some money in taxable accounts, so outside of retirement accounts. Roth accounts are good too, but I really like to save those for the last account we draw from because the power of tax-free growth is very high. So if you're looking at retiring early, you may want to have some money in taxable accounts. And if this change was to go through, this can be an even bigger benefit than it currently is. So in this case, it would actually lower the effective capital gains rate to 11.25% instead of 15%. So that's 4% more money that you would get to keep of your profit. So as you can see, that can be a big benefit to keeping more of your money, and also, really having to use less of your investment returns to live off of when it comes to funding your retirement. So statistically, roughly about 1% of capital gains taxes are currently paid by taxpayers with incomes over $100,000, and over 3/4 are paid by individuals with $1 million incomes. So what they're saying is this tax change may highly benefit the wealthy. But here's the thing that I don't think they're thinking about is there's a lot of people that don't have access to retirement accounts beyond, the standard IRA because their workplace doesn't offer them. So if you were to save above and beyond your IRA, which I highly recommend because $5,500 or $6,500 if you're over 50 is the most you can put away. So you're probably going to need to put more than that away per year to have a really comfortable, confident retirement. And what choice do you have besides to put that into a taxable account? Well, currently, again, you'd be paying 15% because there's no adjustment for inflation. If this were to pass, this could be a huge benefit for people that don't have access to retirement accounts because they're going to pay a lot less taxes on that taxable portfolio, okay? And it could also benefit people that want to retire early because, again, you would get to keep more of your gains when it comes to selling off some investments to cover, the income drop after you quit work and before you have other sources of income that coming in, maybe like pensions, Social Security, and then the benefit of having Medicare. So, it's a really interesting thing to think about. You definitely want to take into account your whole planning scenario when it comes to making a decision of where to put your money when investing for retirement. So essentially, that's what I do. I'm a chartered retirement planning counselor. So what I want to do is offer you some help that if you do need help planning for retirement or making this decision, I do offer complimentary consultations. Usually they're about 45 minutes. And what we'll do is we'll figure out where you're at currently, where you want to go, and then we'll create a game plan to get there, a step-by-step game plan of all the things you need to do, some things you need to be thinking about. We'll talk about some things that you may have already been thinking about, and I'm pretty sure I'm going to help you address some things that you may not have been thinking about because I speak with hundreds of people that are planning for retirement. And so there's a lot of things that have come up over my time of chatting with people that you may not have thought of just all on your own. So if you want help, if you want to discuss your plan to retire with confidence, this is a complimentary consultation. You can go to kisplanning.com. Just go right there, /apply. Once again, that's kisplanning.com /apply. And what you'll be able to do is schedule a time there that works for you. And then once you schedule a time, it'll forward you to a page where you just answer a few questions so that we can best maximize our time together. Most people, almost everybody I've spoken to said they've gotten a ton of value out of this session. And again, it's no obligation. It's complimentary. But what I want to do is chat with you about your retirement and helping you retire with confidence. So if you would like, go ahead and go there, schedule a complimentary session. They are limited. I do not have unlimited sessions. I only give away a few per week. But if you go in there, I'm sure you can find something that hopefully works for your schedule. And if not, just check back at a later time when I open some more up, all right? Once again, my name is Jason J. Hamilton, and I'm your retirement coach. You can find me at kisplanning.com. And if you want to schedule an appointment with me, go to kisplanning.com /apply, and I would love to speak with you. Other than that, have a great day. Hopefully, we'll talk to you very soon, and you have a wonderful week. All right, bye-bye now.